All right, guys. So due to extreme boredom, I'm going to go ahead and do taxes today as well, mainly because I got a lot of stuff to do this weekend. I forgot we have two Thunder games and some other stuff. So um, we were talking about reducing taxable income in the last video with the 401k. So I want to kind of help you all understand how the U.S. tax system works because it's what's called a progressive tax system. We don't have a flat tax or a regressive tax, and I'll explain those to you. We have what is called a progressive tax system. Um, Now, this is not supposed to be a political show, so I'm going to talk to you all, even though most people know I am a diehard liberal. I'm going to tell you some of the things that Trump did different this year. I'm not going to tell you whether or not they're good or bad. I'm just going to tell you what they are, because as long as he's president, that's the tax rate, and that's all that matters. So, to make this simple, I'm only going to use a single person. I don't want to have to explain every different tax scenario that there is. There are four, and then you can Google this and then easily end up on the IRS's website and see what your tax rates are. But there is single, there's married filing jointly, there's married filing single, meaning that the two people are married, but they're each gonna do single taxes, or married filing with a head of household. And that generally happens when you have a stay-at-home parent in a family, okay? But for today, we're just going to look at individuals so that you all can see how the steps work and what sort of deductions are out there and what the conversation is looking like right now in the finance world around taxes. So I'm going to have to read these. So I don't have them memorized, but when you get to the end of the year, you're taxed based on this table. And what makes this confusing is the money that's coming out of your paycheck is the federal government trying to guess. Actually, it's not the federal government, it's your payroll department trying to guess what you're going to make at the end of the year, so that they remove enough from your paycheck so that you don't owe the IRS money or the state money if you live in a state that has state taxes at the end of every year. Okay, so if you're an individual, from $0 to $9,699 is a 10% tax rate. Okay, so then after that, we go from $9,700 to $39,474. That range of money is taxed at 12%. So I'm going to stop here and dispel a myth. A lot of times I hear people tell me, I don't want to fall into another tax bracket. If you hit that tax bracket by $1, only that $1 is taxed at the new rate. So 0 to 9,699 is taxed at 10%. If you accidentally earned 9,700 and you fell into the 12% bracket by $1, only that $1 is taxed at the new 12% rate. Okay, they don't go back regressively and retax all of your other earnings. So our system is progressive. It taxes the more you make. The next bracket would be from 39,476 all the way up to 8,200, and that is taxed at 22%. So only the money between 39,476 and 84,200 is taxed at 22%. And I'm going to stop with the next bracket. There are more. 84,201 to 160,725 is taxed at 24%. In family situations, these brackets are just bigger, okay? So, like I was telling you earlier with the 401k, let's say that you did land in the 22% tax bracket because you made exactly 39,476 for the year. But had you been contributing to your 401k all year and had set back $2,000-$3,000 in the 401k, that would have pulled you back out of the 22% tax bracket and into the 12% tax bracket. And that money you saved in your 401k would have saved your ass from having some money taxed at 22% versus 12, and that money would have been matched by your company. So you come out winning big. Now, the other thing that's different about taxes now than in years previous was when Trump talked about making taxes so easy you could do them on like an index card, the only thing he really changed was he grossly increased what's called the standard deduction. Every year when people sit down to do their taxes, there are certain things that you can claim to reduce your taxable income. Some of the most that people don't know about is the cost of last year's tax prep software. In many states, the cost of renewing your the tags on your car every year is deductible. It's not in Oklahoma, but it is in Kentucky. Student loan interest can reduce your taxable income. Home loan interest can reduce your taxable income. And in the past, before Trump's new tax system, for a single person, that number was $6,000. Well, for me, when I owned my home in Edmond, I was paying way more than $6,000 just in home loan interest, not to count my student loan in and my tax prep software and all that. So I would have to sit down and do what's called itemized taxes, where I'd have to go in and put in every one of these line items and save my paperwork from my mortgage company, from my student loan company. So if I got audited, I'd have proof that the numbers I put in to reduce my taxable income were accurate. Well, what Trump did for individuals was he took it from $6,500, I said six a minute ago, pardon me, to $12,500 as a standard deduction. Well, now that I live with Kristen and sold my home, I don't have any home loan interest anymore. I have my student loan interest, and that's like so little now that I think last year it was like $300. So what Trump did for me in essence was I no longer have to worry about itemizing my taxes. I don't have anywhere near $12,500 worth of tax deductible items. So I just went in and without even worrying about my student loan interest or any of that stuff, I just did the standard deduction of $12,500. So whatever I made last year, it got reduced. And then, I'm sorry, my handwriting is god awful, but then it brought me down into a new bracket on this table, okay? And these are online. These are my scratch notes that I did real quick, but these are on the IRS's website. And if you have children, you get the earned income tax credit for having kids. So there's a lot of stuff that goes into taxes, but a lot of people don't have an idea of how they work or how they got there. But literally, if you were taking the standard deduction like me, I could have sat down and looked at my very last pay for the end of December last year and said, okay, I am not going to be itemizing. So here's what I made for the year that's taxable. Your paycheck stub will show you your pre-tax and after deduction income. It'll have your taxable income. That's after your health insurance comes out, your vision, your dental insurance, your 401k. After all that comes out, it'll show you your taxable income. So I could look at that, minus off $12,500, and then just start doing this simple math here and know exactly what I was going to get back or owe the IRS. So going forward, there have been some talks of changing the tax code a little bit more. One of those is eliminating the state income tax at a federal level. Okay, so that sounds weird, but here's what it is. If you owe your state taxes each year, you can take that as a deduction on next year's federal. If you get a refund from your state, generally speaking, you must claim that as income on your federal. They're talking about eliminating that. There has been some talk of eliminating the interest on your home loan. These are just things that are being discussed. Other things often have a misconception that get talked about in the world of taxes is the estate tax. I hate the term death tax. It's an estate tax. That only hits estates over $10 million, okay? So in the case of my family, my grandfather's got a decent amount of money, but it isn't $10 million, meaning that if he were to pass away tomorrow and leave that money to us, we would not have to pay any tax on it because it's W is the one who moved the estate tax up to 10%. It used to be, or I'm sorry, 10 million. It used to be a lot lower. The other thing is your dividend income. If you begin investing in stocks that have dividends, then those dividends paid you every year, you'll get a form called a 1099-D, and you have to tell the IRS that you got dividend income. That does not go into your earnings. Those are just taxed at a flat 15%. Okay, so no matter how much you make, dividend income is always taxed at a flat 15%. So we have a pretty confusing system, and they're trying to make it more transparent and easier. Increasing the standard deduction went a long way towards that. But the other thing you'll see come out of your check that people kind of think of as a tax, but it's not, is Social Security and Medicare. Social Security, everybody knows what that is. You get a number. You probably get your mail every year and get the number that you're at. You can go do the IRS's website, and you can see right now, if you keep earning how much money, then what your Social Security payment will be. We'll talk about Social Security later, but that comes out of your check, but it doesn't hurt you. It's just setting it back. Same thing with Medicare. A lot of people confuse Medicare and Medicaid. Medicare is mainly for retirees. Medicaid is for people with extremely low incomes or who are in poverty situations. So that's a quick lesson, very brief on taxes. Hopefully that helps you understand our U.S. system a little bit better. Hopefully it helps you understand your tax limits. I would say the bulk of my friends, anybody, I would say each of us, even if you're married, I'd say most of us are going to fall in that 22% bracket, the 39,476 up to 84,200. Some of you might fall over. But I would just say, not looking at the joint rates, if I took even all my married friends and looked at them individually, most of us are probably somewhere in that range. So that gives you an idea. And it's only the money between 39,476 and 84,200. That block of money, which is 40 some odd $1,000, is taxed at that rate. Not everything else you've already earned. And that's a very common misconception in America about our tax system. You'll see Democrats, and often very left-leaning Democrats like Bernie Sanders, propose what is called a flat tax, or like what Europe does, which they call a VAT. It's a value-added tax. So everything is taxed at the same rate. So if everything's taxed at the same rate, me buying a Civic and a super rich person buying a Bentley, yes, it's the same rate, but then the dollar amount that they're paying in is massively more than me, because I can't afford a Bentley. I can't afford a mansion. So those are things that are talked about. They're batted around. I knew a guy once who lived in England half the year and America half the year. And he said it's really net about the same. He said when you're over there, you have more money in your paycheck. But when something happens, like your kid needs braces or you need to get new contacts, you don't pay anything for it. And over here, you have, I don't know what I just said. It's less money in your paycheck over there. Sorry, total brain fart. But those things you don't have to pay for. And then when he lives over here, you have more money in your paycheck, but if your kid needs braces, there's a deductible, or you might have to pay for your contacts, pay a certain amount. So just two different systems. I'm not saying that one's better than the other. But that's kind of how taxes work. When you hear people talk about us having a deficit or whatever, that is where just the government is spending more than it brings in taxable revenue. So the only revenue our government can technically bring in is taxes on businesses and us. There are other ways that are small, but those are the two biggies, really. So hopefully that helps you understand your personal taxes a bit better. Most people shouldn't have any questions over that. I was just explaining the tables. But if you do, you're free to hit me up and let me know. So now I'm going to go find something to do with the rest of my Thursday. You all have a good day.